Good morning, everyone. Welcome to this rundown for global stocks and commodities for the 19th of August. Uh, as well as looking at the normal market indices and commodity price indices, I just want to address a bit of an age-old question that I get questions on from time to time, and that is the choice between fundamentals and value investing and momentum investing, in other words, going with what is. So I just want to address that briefly and shed a little bit of insight into that. So let's jump in and have a look at what was another very interesting week. So we'll look first of all at this question of fundamentals and momentum and which one should take precedence. We'll do the normal stock and commodity trend update. And Portfolio Analyst last week was a review of a number of substantial Australian winners that we've had in Portfolio Analyst, and there's been quite a significant number. And I also introduced another strong long-term buy, which I think, despite the fact that it's already gone up a decent amount, still has large potential over time. So some very, very interesting and lucrative stocks coming out of Portfolio Analyst. So let's just address this question of momentum versus value. Now, either works over the longer term, but you need to be very clear about what type of investor you are. To my mind, value investing works well over the very long term. We're probably talking time periods of at least 5 to 10 years. And in my experience, having dealt with thousands and thousands of traders and investors over the last decade and a half, is that most people don't have what it takes to go through the periods where value investing lags significantly, as it has been for probably for most of the last 4 or 5 years. Value investing has taken very much a backseat in terms of performance, both in relative terms and also to a degree in absolute terms as well. And that's fairly typical. Value investing, which is often around defensive kind of stocks, generally lags badly in bull markets. Value investing does very well in bear markets, but that's certainly not what we've had recently. So you've got to have a huge amount of patience and probably not particularly high aspirations for return to be a good value investor. Certainly, I know that it just doesn't suit me, at all. I'm much more a growth and momentum type player. Now, growth stock investing can pay off very handsomely, but the research has got to be very good because it's easy to fall into very, very overvalued growth stocks that are just looking for a reason to fall over. So your research really does need to be very, very good. And you need to be able to make good assumptions, or whoever's doing the research needs to be able to make good assumptions about how the next few years is going to unfold. And if you want to be a pure momentum type of player, then really I think that's for traders only, because momentum pretty much ignores value. Doesn't so much ignore fundamentals, but it certainly ignores value. And it basically says, well, look, if the price is going up and it's looking strong, then we'll ride it until it stops going up. So it's really a trend following approach. And that can work really, really well also, and I think is the best shorter to medium term kind of approach to the market. But you need to be very clear about your game plan. You certainly need to have your exit strategy sorted out very, very well. And again, in my experience, it's the exit strategy that most people are weak on and lacking in confidence. And I know when I chat to people about their trading and what sort of educational gaps they feel that they have, invariably people go straight to exit technique, how to take profit when something is doing really, really well. Let's just take a look at a few charts just to underscore the point that I'm making. So we'll start first of all just with some stocks in the States, because there's been some just amazing long-term trends, very robust trends, but also very stable trends where there's very little volatility either side of the 50-day moving average. So these aren't recommendations at all. They're just some observations. They tend to come from a sector of the market that has had enormous momentum now for some time, and that is basically software as a service, global mobile payments. All that area has been enormously strong. And this is a stock called Global Payments, and you can see back in 2013 it was trading at $24, and now it's trading at $120, and it's been a remarkable uptrend. We had a bit of an interruption to the trend in early 2016 when everything the whole market had a bit of a wobble and looked like it was breaking down. But you can see the trend has continued. Now, this stock, just to give you a bit of an idea of value, has a current PE of 34 times. It has a forward PE of 23 times, which is certainly not cheap. And if you look at it from a value perspective, on the way that I do my calculations, it's about 15% overvalued. But the trend is tremendous. And we're getting another consolidation period here at the moment, which is quite normal, but showing all the signs of breaking out of that. So here's our consolidation that's occurred after another really good run up from around 80 to 115. Consolidation sideways for a while, let everything catch up, but it now appears that we're to the end of that consolidation phase and we're just on the cusp of breaking out and running again. So what do you do with a stock that you believe is overvalued, but the technical pattern is just so compelling, and it looks like after a relatively brief consolidation that started in the middle of March, it looks like it's about to go again, and that's the dilemma that a lot of people face, and it really is so important to have clarity around your whole game plan. Let's just look at a few others. This is Adobe software, which I'm sure everyone's heard of. So again, a tremendous uptrend that's been running for a long period of time. It's gone up by a factor of about 6 or 7. Hasn't really ever got ahead of itself. It's just been a wonderfully stable uptrend. This stock is certainly overvalued in my view. This is another emerging stock that's only just reached profitability in the software as a service industry, but you can see just a remarkable uptrend from the low 20s, and now we're at 60. And that's all basically occurred in the last 3 months, not much more than that. Now, in the very short term, this stock is overvalued, and technically it's also stretched, so I wouldn't look at it from that perspective. But just a wonderful uptrend. And finally, let's look at another stock called ServiceNow. Again, in the software as a service business, a lot around cloud computing, and it's just, I could literally show you hundreds of these types of trends in the States. Whereas the majority of the value stocks that are trading at prices that would appear to be significant value, there's no price trends there at all. They're basically going sideways. They're being left behind, if you like. So I think the best advice that I can give to people is just to seek clarity around what sort of trader or investor you are, and then really zero in on the appropriate kind of stock that meets your needs. So for me, the ultimate solution is you want growth. Growth stocks are where the performance is over the longer term, but you want to be able to try and get growth at a reasonable price. And certainly in America at the moment, that's hard to do. I spend most of my day doing that, and I can tell you there's not too many opportunities where I can find that I'm ticking all the boxes, that I've got the growth, and I've also can get a really good price as well. Let's look at the market in general. American stocks up 28%. Up 28 points, 1% for the week. and earnings season now is officially over. There'll be a few results still come dribbling through, but more than 90% of the S&P stocks have reported now, and it's been a tremendous earnings season. It has certainly lived up to expectations, and in fact easily beat expectations. The blended rise in earnings for the S&P 500 was a 25% growth in earnings, which is which is tremendous. Now I know that the energy sector did contribute a meaningful amount to that percentage rise, but look, this was very, very broadly based. And I also acknowledge that the tax cuts, which are to a degree a one-off, they helped. And I'd be more concerned if sales were flat. So the earnings had gone up merely because of the tax cuts. But that is not the case. Sales have still managed to rise 10% across the board as an average. So that's a good, robust outcome. And also the tax cuts, whilst in their own right are a one-off, they do lead to a higher level of confidence both at the business and the consumer level, and they also lead to more reinvestment, and that's has a positive impact in future years. So it's not purely a one-off. The other really interesting stat is that 79% of S&P stocks beat earnings estimate. That's a really high level. If you think back over the last few years when I've been regularly reporting this every quarter, it's more normal to see somewhere between 68 and 72, 73% as the beat rate on earnings. So 79 is really high. I can remember an 80%, but I can't remember anything much higher than that. So the guidance was raised. The corporate America set the bar higher and then went out and beat it at a very, very significant rate. And I do note that the highest number or the highest percentage of earnings beats were to be found in the technology sector and also in healthcare. So that's an area to go hunting. The other aspect too, which is important, is that market breadth remains very high. Now, a lot of commentary at the moment from the people that want to pick holes in what's going on is around the fact that the FANG stocks, Facebook, Apple, Amazon, Netflix, Google, etc., are the ones that are holding the indices up. And look, there's no question that they have a significant level of weighting in the index, and so therefore do have an impact. However, the market breadth by a number of other yardsticks is still as high as ever. You look at the advanced decline line, it's basically near its all-time highs. If you look at some of the equal cap weighted indices, which take away the effect of the very large cap stocks, so it just treats every stock, their gain or loss, irrespective of their market cap, then those indices are still basically rising and near all-time highs. So whichever way you slice it, the market breadth remains very high, and this is not a market that is just being sustained by by the top 5 or 6 largest stocks in technology. US dollar was flat for the week. It was up strongly early, then it dipped towards the end. So a bit of a roller coaster, but look, that was to be expected. We had a very powerful breakout in the dollar thanks to what was happening in Turkey, which caused the euro to fall and therefore the US dollar to go up. So that was always going to back off to a degree. So let's jump in now and look at the US market. So this is the S&P, still in uptrend. Nothing has really changed. It's taking its time, having another assault on these all-time highs up here at 28.75, but you've got to say we're still getting higher highs and higher lows. Now, they're only minor, but nevertheless, that you've got to say that uptrend is still pretty much Sorry, got the wrong one. I'll just extend that up. That uptrend is still pretty much in play. And if you just want to acknowledge what you see on the chart, then you would think that a breakout to new all-time highs is the most likely outcome. It's pretty hard to argue otherwise on this chart. Let's look at the Nasdaq. Also too, just consolidating below all-time highs, but still looking very strong. And the Russell is no different. We've got a bit more of an extended consolidation period here, but that really is just in response to the fact that the Russell had got ahead of the other indices. And now it's going sideways and the other industries are catching up. The US dollar, so really strong breakout as we saw. I suspect that the data on these two candles here, Monday and Tuesday, is not quite correct because that's not how it happened. I think the opening price in the database is probably not correct. But look, we basically finished where we started is the bottom line, and we're still in a very clear uptrend in the US dollar. And of course that is contributing to the Australian dollar, which had dipped under this 73 support level on last Friday. We went down almost to 72, and then as the US dollar came off towards the end of the week, we saw a bit of a rebound, but we're only back to the breakdown level. So just panning back, likely we'll see some technical support at 71.7, but then there's really nothing to hold it up until we get down to about 68.5. So there's no question the Australian dollar is in downtrend. Yeah, I mean, that's all you can really go with is what we can see. Now, there's always a possibility, of course, that Donald Trump and his tweet can change the landscape on currencies. If he decides that he doesn't like the US dollar where it is and he sends out a tweet, then that could have some short-term impact. But the longer-term fundamentals, as I've been saying for quite a long period of time, really favour the US dollar rising and the Australian dollar going down. Turning now to Aussie stocks, our dollar finished at 73.1, and our index rose by another 61 points. So the index has done what I didn't expect it to do. I believe that the banks were going to be a drag on this market, and certainly there's been support coming for the banks in the last few weeks, and that's helped push our index up. But nevertheless, I still think the fundamental structural headwinds for our banks are such that I just can't see them going into an uptrend and returning to their highs. There's just too many things against them. And certainly the Royal Commission has caused the banks to pull back their business in a couple of areas. One, they're getting out of wealth management because they just weren't any good at it. And secondly, they're going to be pulling out of some areas of corporate lending, particularly in the smaller end, and that certainly favours some of our fintech stocks. But they're also going to have to brush up their lending standards to the housing market, which is also coming off the boil. So wherever I look, I just see headwinds for banks, and I don't see too many tailwinds. So I just don't know how much more upside the ASX 200's got in it. Now, we're just starting earnings season in Australia, and there are some highly variable results, I must say. Some stocks significantly disappointing the market and being marked down very, very severely. I've seen declines of up to 50% in a day, which happened to a stock called Eclipse that downgraded their outlook. But equally, there's been some very good results, and companies like JB Hi-Fi, for instance, came out with a good result. So early days yet for the Australian reporting season, but my view remains the same on Australia, and that is it's very much a stock picker's market. So this is the ASX 200. you can see we've broken above key resistance levels now. It is trending. We're still below our 2007 highs of almost 6,900 points, and who knows, it may tend to work its way back up there. But I really struggle to see it from a fundamental point of view with the banks. So that's the Australian market. Let's turn now to precious metals. Gold fell very sharply, down $27, down to $11.85. And of course, with that break of $1,200, that was always going to result in a bit of a technical response to that. And there was some very heavy selling, took it down into the, I think into the 1160s at one stage before we got quite a nice reversal to finish the week. But I have zero confidence that that reversal actually means anything in terms of a significant rebound. I think it's likely that it's just a reaction from being technically oversold, and it's also, I'm sure, partly due to the fact that the US dollar came off on Thursday and Friday. Precious metal stocks, we'll look at GDX as a proxy for global large cap gold stocks. It's had a major breakdown from support, and it's gone now to another support level, and is sitting right on that support level. So this is pretty critical right here for gold. So let's take a look at gold on a weekly first. So quite a significant breakdown. I'll just get rid of this uptrend because that's certainly no longer in play. We had a very significant breakdown. We broke that level there, which was around the 1230 mark, and then we managed to also break this important level. And the next one you're looking at is down around 1122, and you can see last week we did get to a low of 1161. So that was a very significant breakdown before we got that bit of a bounce back on we got some stability on Thursday, and then a much better session on Friday night. But gold is in downtrend, which I find really interesting because I would have thought there was a fair amount of fear around at the moment with issues around Turkey and Europe, some weakening economic data in Europe, all of the constant fears and chatter we've had over China and the trade wars. I would have thought there was enough fear around the place to have given gold some support, but that certainly has not been the case. Now, just looking at GDX, so this is on a weekly chart, you can see we're in a very long-term sideways consolidation that started over a year and a half ago, and that has now given way completely. Now we're sitting right on important support here. If that breaks, then we're probably looking at another leg down in GDX towards the 13 mark. Closed the week at 18.7. So there is still the potential for some significant downside in the gold market. Now, I'm not saying that's going to happen. It's just you've got to go with the trends that you can see, and at the moment that's pretty obvious. Turning to other commodities, copper was at 265. It's now clearly in a breaking down trend, which just completely defies the fundamentals. Every week I talk about the supply and demand situation for copper, the fact that we're going into or are already in a situation where supply is less than demand, and so therefore copper stockpiles are or will be drawn down. And so this slide in the price of copper certainly is not consistent with the fundamentals out there. So, I mean, what it's saying is that there is expectations that global growth is going to slow significantly. And whilst there are a few little indications in Europe, you really can't say that broadly. And we know that the Chinese keep stepping in when they need to stimulate their economy. Crude oil slipped again down to just a tick under 66. The inventory levels went up to just above average, but look, that's just a day-by-day, week-by-week fluctuation. The stocks were down, but there's no real trend evident yet to my way of thinking. Let's just look at the XLE. So let's pan back and take a bigger picture look. So it's been volatile. XLE has fluctuated between 62 and we got up to nearly 80, and then we've been in a tighter range now for a few months. But you really can't say that there's any real trend there at the moment. So that's the energy market. So I think the most likely outcome is we're going to see consolidation for some time, but then that also creates opportunity looking for, for the good quality producers, the good quality growth stocks that have got the best acreages and the lowest debt levels, and to buy them when they dip. There's the copper chart, and there we are with crude oil having slid all the way back down to support over the last few months. So just to wrap it up, the US scene, both economically and profit-wise, is in great shape with all the results that I showed you earlier. And it's hard to find value in America. So again, this comes back to the important question, who are you? Are you a value investor, or are you a momentum player? And it's been a wonderful market for several years for growth and momentum players. There are still some very strong, stable uptrends in place, setting new 52-week highs. I showed you a few of those, but there are hundreds and hundreds of them. The Australian market is different. We're not seeing broadly based sector and industry group trends like we do in America. It remains very much an individual stock selection type of market. Yes, we're seeing some coordinated strength in fintech stocks like Afterpay Touch, for instance, which I'll just touch on in a minute. But we do tend to lack sector trends. So let me just have a quick look at APT, because this is a stock that has been originally recommended in September 2017 in Portfolio Analyst, and has subsequently been covered on 7 occasions. Now, originally, this was recommended at $4 or to buy below $4.20. So way back here, we're now trading up at $16.60, and I've analysed this stock to death over and over again, and it's certainly really delivered in spades. And you can see after this consolidation period that we had here that finished in June, we then got a massive run up in price, and it was way above the 50-day moving average, significantly extended, and I would have expected a pullback that brought the stock back to perhaps somewhere between 11 and 12. So this was the area through here that I was expecting to see a retracement to. Now, the fact that we didn't get that, the pullback was extremely shallow. You couldn't even really call it a pullback at all. The volumes dropped away really, really quickly, and then we've started to turn up again, and we appear to have just taken off again into another uptrend. So it's a stock that's extremely hard to value because it is so new in its profitability growth path, and we're looking at if the expansion of their business in the States goes well, then this share price is going to continue, I believe, to head higher. But of course, that's always the risk. So this has been an enormously successful trade. It's certainly been my most successful trade this year. But it's just it's typical of the sorts of analysis that I do in Portfolio Analyst every week. So if you've not taken advantage of that 2-week free trial, then you may wish to do so. Portfolio Analyst this week, I've got a couple of strong opportunities again to present, and of course always some really good member questions come through as well. There's my contact details for any non-members, and we'll see what the coming week brings. Cheers.